Welcome to The Close. I'm Matt Scooby. Markets are going to be closing in half an hour from now. But first, let's get to some of the other stories that we are following in the BNN Bloomberg newsroom. Bloomberg reporting that Canada, the U.S., and Mexico will not meet the CUSMA renewal deadline of July 1st. Part of the agreement does include the possibility of extending the deal for 16 years. If the countries don't agree to renew it, CUSMA remains in place until at least 2036 and will enter rolling annual reviews. According to the report, by declining the formal review, the Trump administration will trigger negotiations and an indefinite period of uncertainty about the agreement. Shares of TerraVest Industries are taking a hit. The company reviewing allegations concerning its executive chairman, Charles Pellerin, after reports of insider tipping. Quebec publication alleges Pellerin provided family members and acquaintances with inside information ahead of the company's 2025 acquisition of Antrans International. TerraVest says that it takes the allegations seriously and, if approached, will cooperate with regulators. Pellerin has been executive chairman since 2014. Well, is it or isn't it? A new report from the C.D. Howe Institute says 2 quarters of declining GDP in a row are not enough of a downturn to label Canada's economy in a technical recession. The report says the sluggish nature of the economy is not widespread enough or persistent enough, and caution that declines in the first quarter may still be revised over the summer months. And one industry not badly hurt by U.S. tariffs is the aluminum sector. The Aluminum Association of Canada says the industry is operating at 95% capacity without layoffs or slowdowns. The CEO says tariffs have been less painful than anticipated. Last June, the U.S. administration raised aluminum tariffs from 25 to 50%. Let's have a look at the markets today. There is a lot of red over the course of today. The TSX down today over 2%. Right now, over 800 points, weighed down by losses in base metal and the technology sectors in particular for today, ending what has been a pretty impressive run. South of the border, U.S., again, also being weighed down by the big technology companies that have lost a ton of ground over the course of the day today. Look at the NASDAQ, down over 4% just for the day today. We've been talking about record highs at different points. Was going to have to come back down to earth a little bit, and we are seeing that to end the week too. Bond yields jumped too after that strong U.S. jobs report, also boosting expectations the Fed may be forced to hike interest rates at some point later this year. Let's have a look at some of those big tech stocks that are tumbling today. Talk about Broadcom, Nvidia, Micron, all seeing big drops today as concern continues to grow over the sustainability of an AI-fueled rally that had pushed the chip stocks to records and made Micron a $1 trillion behemoth, but some significant losses. Micron down almost 13% today. Strategy, Meta, and also some other tech stocks that are under pressure today. Keep in mind Strategy too, right? Bitcoin actually dropping down and chopping below $60,000. It's the lowest level that Bitcoin has been since October of 2024, and a drop of the 6th straight day. It's almost cut in half the value that we saw from a record high back in October of 2025 when it was up around $126,000, but some significant drops across the board. We'll touch on the U.S. jobs report, but Canada's economy also adding 88,000 jobs in May, and the unemployment rate fell back to 6.6%. However, our next guest says that beyond the headline numbers, the economy is still barely scraping by. Let's bring in David Rosenberg, founder and president at Rosenberg Research and Associates. David, thanks for being here.
My pleasure. Thank you.
You know, we get into this too. It certainly looks like it's a good number and certainly strong as we've seen some of the reaction to it. But take me through your initial thoughts on what we could see and likely behind, some of those numbers that we saw from the employment report today.
Yeah. Well, look, it was a blowout number, and there were no special factors. And, the work week was up and unemployment rate went down. And the breadth of the number, I could tell you, was better than what we saw in the United States. But the one thing that we have to know about the Canadian number is that it's a survey of like 60,000 households with a pretty wide error term. And that's why if you're taking a look at the monthly Canadian job data, they bounce around like a yo-yo. And I don't know why, any Canadian bond trader would ever lay down any money on what the number is going to do straight up or relative to expectations. It's just so volatile. So what you want to do with the number is take a look at what the trend is. The year-over-year trend, because you want to smooth out the monthly noise and all the gyrations, especially in this piece of data. The year-over-year growth rate in Canadian employment is the grand total of plus 0.7%. It's microscopic. So it's consistent with what we're seeing with the economy, which arguably is not in recession, although that's really, in my opinion, more of an academic debate. The economy is fundamentally weak. And even with today's huge number didn't even cut into totally the big declines we had in previous months. So we're still down. We're still in the hole in terms of employment by 25,000 so far this year. So you look at 88,000, you say, wow, what a great number. The latest data point, it's just incredible. But you have to take a look at the context of what's been happening over the past several months and the past year. And it just speaks more to the volatility of the data than anything else. I'm not going to dismiss the data. I'm not going to nitpick negatives, because there weren't really many in this particular report. But the trend itself tells you a lot as to what's happening with the economy, because whether you're taking a look at real GDP, or you're taking a look at employment, or you're taking a look at any of the major macro variables in Canada, they're running very close to zero. And if you want to go to the public and say, well, that's not a recession, go knock yourself out. But what it does is it reveals an economy that's flat on its back. So it's not a recession, but it's just a rung or two on the ladder away from being one.
And how far away? How far on that rung for you, David, at this point, are we away from seeing an actual recession?
Well, firstly, that's a very difficult question to answer. I'd say that, if, for example, these trade negotiations with the United States don't go so well, and it causes this lingering elevated level of uncertainty, that's going to be an impairment to capital spending. If Donald Trump doesn't manage to head to the exit ramp that he so desperately wants to do, because Iran is showing that they have as much a say on the veracity of any truce as much as the White House does, and oil prices stay elevated. That's good news for Canadian energy producers, but over 60% of the economy is the consumer, and it's not good for consumer spending. You have to take a look at something else, which is something I think that was mentioned in the lead up to the show, which is the OECD outlook for the global economy. And they actually think that the global economy could be on the precipice of a recession. And that's a big negative feedback loop into Canada, because the Canadian economy, when you think about it, is a torque on global GDP. So I think there's a lot of headwinds away. It's hard, what are we going to do? Sit here, the CDIO Institute has multiple definitions of what a recession is. And to sit here and try and, guess what the CDIO is going to do, to me, is a bit of a waste of time. What's really important is, where is Canadian aggregate demand growing? That's GDP relative to aggregate supply. And that's otherwise known, that differential is known as the output gap, the degree of idle capacity or excess capacity in the economy, because that's ultimately what drives inflation. It's very interesting, don't you see how interesting it is? It might be early days yet. We've had this energy shock, and yet core inflation is not going up. At the margin, it's going down. There's fundamental disinflationary forces in Canada beyond the energy shock, because the demand side of the economy is lagging behind the supply side of the economy. And the supply side of the economy, by the way, isn't going gangbusters either when you look at productivity and employment. So that's driving this, what the Bank Canada, what economists call the output gap, excess capacity, putting downward pressure on inflation. That will put downward pressure on corporate profits. That will in turn put downward pressure on employment. So what's more important than calling the recession, and I'm not trying to back out because it's uncertain. What's more important to me is, where's Canadian demand going relative to aggregate supply? That's more important. And if we continue to see the output gap in Canada widen, that's going to create disinflationary or deflationary pressures in the economy. I think it'll force the Bank of Canada to cut interest rates. So you can actually come up with a whole range of investment opportunities for people out there without calling for recession, because when you have a widening output gap, it might not be a recession, but for a whole lot of people, it feels like one.
Right, and that's going to be interesting here in the coming months. David Rosenberg, founder and president at Rosenberg Research and Associates. Appreciate your time today, David. Thanks so much for this.
Have a great weekend.
Well, up next, a conversation with AI Minister Evan Solomon on Canada's new AI strategy. We're back in a moment. Stay with us. OPEC ministers gather on June 7th for their first biannual policy meeting since the United Arab Emirates left the alliance last month against a backdrop of extraordinary disruption. While the group is expected to maintain current output plans, investors are paying attention to the UAE's bet for more independence in global oil markets. Bloomberg's Abir Abu Omar reports.
The OPEC Plus ministerial meeting on June 7th marks the beginning of a new chapter for the oil producer alliance. After years of pushing against production limits, the United Arab Emirates left the cartel in a surprise move last month. It was the third largest OPEC contributor, accounting for 3% of global crude supply. The exit opens a possibility for the nation to get its money's worth from recent oil field expansions. State energy company ADNOC is on track to raise production capacity to 5 million barrels a day by next year, up from 3 million barrels a day back in 2018. But today, producing more oil is only a part of the equation. The ongoing crisis in the Strait of Hormuz has highlighted that easily getting those barrels to market can no longer be taken for granted. That's why ADNOC is also accelerating an expansion of its Fujairah pipeline, which runs to the Gulf of Oman, bypassing the choke point. The route already carries up to 1.5 million barrels a day and has proved to be a lifeline during the Iran war. By next year, the project will roughly double that capacity. Regional rival Saudi Arabia is also expanding alternative export routes, underscoring a wider Gulf effort to ensure that billions of dollars of production growth translate into profitable exports. It's a new reality that OPEC cannot ignore. No longer just about how much crude can be produced, but how much of it can actually be delivered.
That's Bloomberg's Abir Abu Omar reporting for us. When we come back, we're going to bring you that conversation with AI Minister Evan Solomon on Canada's new AI strategy. Stay tuned for that after this. Prime Minister Mark Carney and Artificial Intelligence Minister Evan Solomon on Thursday unveiled Canada's new AI strategy. It's received some mixed reactions over the last 24 hours. Some have called it ambitious, while others are concerned that the push could result in Canadians losing their jobs. For more, we want to welcome in Minister Evan Solomon. Minister, thanks for being here.
Great to see you, Matt.
Let's get into this, shall we, too? You know, the strategy for you and what we outlined and we heard yesterday, committing at least $2 billion in new investment. We were able to research, private companies in this country, are spending almost that amount on one data center alone. So I think my first question is wondering, is that enough money, as we watch this rapid expansion and considering what's happened, in particular south of the border?
So, Matt, the strategy AI for All is a pragmatic approach, and it's kind of got three pillars: trust, opportunity, and sovereign control. And, obviously the first thing is trust, and there'll be forthcoming legislation on privacy to make sure that we will protect Canadians' data, we'll protect their privacy, we're going to protect kids. And look, we're going to get a lift from AI, and we'll get those 250,000 jobs in 5 years if we get the adoption, if people use it. We're the lowest adoption rate in the OECD right now, so we've got to improve adoption. The only way we'll improve it is through trust. But you talk about investment. Let's just talk about this and not underestimate it, because remember, we're building on what's already going on. There's a big program going on to unlock sovereign data centers right now, Canadian data centers. We just did a project and with TELUS that we're exploring this partnership to build data centers in Vancouver and British Columbia that are, again, built with hydro, closed loop water systems, which means we're reusing water, reusing the heat from the data center for 150,000 homes. So you've got to build these things right, or people won't want to build them. But let's talk about the investment. We just set up a $500 million Canadian tech growth fund that will take equity stakes in small, medium-sized businesses. Small, medium-sized businesses and innovators are the backbone of our economy. And we've got $500 million from the Business Development Bank of Canada through the LIFT program. That's $1 billion. We've put in $500 million through the regional development agencies, through the Regional Artificial Intelligence Initiative. $500 million going to SMEs. SMEs told us they need compute, Matt, which means compute's the innovation that they need, the fuel for innovation.
Yep.
We had a $300 million fund. It was our most popular fund. We've now added $700 million. What does that do? It subsidizes compute for our small businesses to get the compute to solve the problems. And they get a big subsidy and an incentive to use Canadian compute. So we subsidize, so we instill growth in Canadian companies.
Right.
So right there is $2.3 billion. Another $200 million fund, a missions fund in health to show investing in healthcare outcomes and initiatives that are doing that. So, this is, $2.5 billion on top of investments in our CFAR chairs, which is our world-class researchers. We're going from 143, the best in the world, to 200. So this is a major investment in our technology, in our small businesses, in our medium-sized businesses, and our major businesses. Let me just say one last thing, because sovereign control matters. Matt, there are only 4 countries in the world that have a large language model. There's the United States, and you know them, OpenAI, Anthropic. There's China. France has one, and Canada has one, Cohere. So we have real advantages. We, of course, have an MOU as a government with Cohere. We've just bought 1,400 licenses.
Yeah.
They've just done a deal to acquire and partner with a German company so they can expand to Europe. So we are competitive. We are going to protect Canadians' data. We're going to invest in our economy. And absolutely, we have the instruments and the power to succeed very well and give Canadians an absolutely powerful role here in AI.
And so let me ask you too about the sovereign part of this too, because we know that Amazon, Microsoft, and Google are dominating, right? It's roughly 85% of Canada's public cloud market are on American clouds and are on American companies. So how does Canada do that and become more sovereign in that and balance that dependence on U.S. Cloud's foundation and the model of providers that with the goal of building that competitive, you talked about it, your domestic AI ecosystem?
Look, the strategy is very candid, and people will read it. It's a detailed, pragmatic strategy of how we're going to grow. We got to, we're going to build, partner, buy. We're going to build on our competitive advantages, like Cohere, like many of our great companies, Coveo, Ada. These are, Clio, some of the best AI companies in the world. Remember, we've got 150,000 people currently working in AI alone, and 3,500 different amazing companies, and 800,000 Canadians working in the digital sector. So this is a very fast-growing, the fastest-growing sector. But you're right, we have weaknesses that we've got to build on. And I always say sovereignty is not solitude. Sovereignty means choices. So this strategy is about making sure that we build up our sovereign cloud capacity, absolutely, working with Canadian companies like Denver, Canadian companies like ThinkOn. And that's why, as an example, when we have the Compute Access Fund, that small, medium-sized companies can get access to compute, they are incentivized to use the Canadian companies first, so we build up that capacity. So this is a really big strategic part of our strategy that you see in the AI for All strategy that we just launched.
Okay, so let me ask you this, and let me go back to jobs too, Minister, at least at this point. You talked about in the goal, 250,000 jobs over the course of the next 5 years, and you talk about adoption, right? Canada ranking, it's not really, anywhere from 12 to 15%. The number varies right now. You want to get that up to 60% too of businesses by 2034. But on the other hand, we have research too. You have Signal 49 research out earlier this year saying that as businesses and companies adopt AI, we're going to see job losses possibly at 550,000. Over 500,000 jobs are going to be lost. Do you have a net number of what you're expecting to in there that as you watch those job losses stem at the tide of as businesses adopt AI, even with the jobs that it may be creating?
So let's get some baseline before we toss around dozens of different models. The first and foremost responsibility, if you want to build an economy, this is not just for AI, this was in the age of the internet, the industrial age, is to have an educated, skilled workforce of the future to adjust to what any technology needs. A major part of our strategy is to invest in an educated workforce. So it's a really important step. So remember, we are launching a national AI literacy program to make Canada one of the most AI literate countries in the world. Every Canadian will have access to this course for free. We are investing in our young people. We are creating 90,000 new job spaces, working for young people. I just got back from one of the organizations that we're partnering with, MyTax, that puts post-secondary students, postdocs, doctorate students within companies to create jobs, and then they often get hired by those companies. We are creating 90,000 spots for jobs for young people to create those jobs of the future. So look, that's really important. But you're asking about job disruption. Let's be data-based here. I mean, we're on BNN Bloomberg. So the Bank of Canada 2 weeks ago put out a study that said so far, and I want to be careful here, so far we have not seen in Canada any AI-related job losses in a big way. Now, that doesn't mean that things aren't happening or things won't change as adoption rates go up.
Right, and but you have to attribute that to the adoption rates, right? Like that's because we haven't seen, it's not, businesses aren't adopting it yet.
Well, hang on a sec. Let's just make sure we're comparing the right models. The OECD numbers that we use to base on for our model, which is to create 250,000 jobs, is based on OECD numbers that are created based on high adoption rates. I think we got to be careful before we just say the adoption of AI necessarily means fewer jobs, any more than any technology in the past has always created jobs. Again, I'm not suggesting it's only going to create jobs. There'll be disruption, but we need to invest in education. We, in one of our clusters, we have a digital cluster called NGen. They did a study of 122 different industrial projects that are using AI in their
30 seconds left, just so you know.
And they found that, well, productivity went way up, so did jobs. They didn't lose jobs. They created more jobs because they were more competitive. So look, this is a big opportunity. We have to be open to the opportunities here. We should be candid about the concerns, job loss, privacy. That's why we're going to take trust measures to protect, measures to have a skilled, literate population in these tools. And again, we haven't talked about this, but this is a big item. We are going to make sure that every post-secondary student has access to a reliable, safe AI tool, like an agent, Matt, so they can they have the experience to use this so they can participate in a skilled way in the economy of the future. Super important.
Minister,
we have a skilled workforce.
It's a big conversation. We're going to have more about it, but appreciate your time today, AI Minister Evan Solomon. Thanks for your time. Well, up next, the closing bells on Bay Street and Wall Street. Stay tuned for those. Well, here are the closing bells of the NASDAQ 2026 Special Olympics USA Games. They're ringing the closing bell on the New York Stock Exchange. Future Corp ringing the closing bell. You're watching The Close on BNN Bloomberg. I'm Matt Scooby. Here is how we close the day on Bay and on Wall Street. All of the major markets pulling back significantly over the course of the day today. On the TSX in Toronto, down over 2% for the day today, over 800 points. We talked about it. Base metal technology sectors in particular seeing some of the biggest losses. It was a similar theme too south of the border. Look at the NASDAQ, down over 4% just for the day today. We've been talking about record highs pretty much right across the board being pushed forward, but again, certainly scaling back and pulling back a little bit right across the major indexes. You look at some of the movers, NVIDIA too, down over the course of 5%. Let's have a look at some of those tech stocks. that have tumbled over the course of the today. Broadcom down over 7% just on the day on Friday, just alone for intraday trading. Nvidia, we talked about it, down over 5.5% too for the day today. Micron, a huge drop too as well, over close to 12%. At least for right now. Otherwise, too, we were seeing a few others that have also, talking about the sustainability of an AI-fueled rally that has been pushing those chip stocks to records, too. But the strategy, Metis, also all down, a lot of red, pretty much as you look right across the board. It started the day in the red, and we never were able to rally out of that. But strategy down over 8%. Huge holder of Bitcoin. Bitcoin has been taking a hit over the last week. 6 days in a row, it has seen significant declines, now sitting at its lowest level since October of 2024. Strategy sold off just a few of their Bitcoin holdings, and that has led to that significant drop. Meta down, Sienna also down, at least for right now, too. How about here in Canada? Celestica, also a victim of the tech sell-off here today, too. Down over 12%. Is still, again, up significantly, but look at that drop just for the day today. We'll see what happens next week, but this is certainly clawing back some of the gains and some of the record highs that we have seen over the course of this week. For more now, we are joined by Bloomberg's equities reporter, Stephanie Hughes. Stephanie, certainly, again, a lot in the red, not alone for the tech stocks either. Lululemon also didn't have a very good day, too, in the markets.
That's a great way to put it, Matt. Happy Friday. Lululemon had a pretty rough go of things today. Those shares fell by over 12% at its lowest point. That was enough to drag the stock price to its lowest level since 2018. So that's like pre-pandemic levels of trading there. And that came after the yoga clothing retailer reported earnings after the bell last night. But what traders were really zeroed in on was the fact that they slashed their guidance for net revenue for fiscal 2027. So the company said that it's expecting to rake in about nearly as much as $11.2 billion, which was lower than they initially, accounted for. And also it came below the near $11.5 billion that analysts were expecting. So Lululemon, just to give a little bit more context, particularly with this quarter, has just been struggling with lower sales, particularly in China, where analysts flagged some particularly weakening segments. And that's a major market for them and for a lot of retailers, too. That, and it prompted a few analysts to downgrade their rating on the company. And in fact, there's only one single Wall Street analyst that still has a buy rating, still encourages traders to pile into the stock, or at least buy a fair here and there, and that's Zachary Waring from CFRA. Beyond that, the consensus rating, so all the analysts, the average of all the analyst ratings on Wall Street, it's at its lowest point ever since the stock started trading back in 2007. So it really is a far cry from late 2023 when Lululemon was reaching its all-time highs. Since then, it's been grappling with slower sales, some tariff headwinds, particularly since 2025, a proxy battle with the brand's founder, Chip Wilson, which did wrap up actually just last month. And so a few other been grappling with a few other challenges, and the fact that the new CEO, analysts and traders alike, didn't seem to be all that impressed with the new appointment as they're really trying to embrace this turnaround strategy. So this latest earnings print this week is really not helping the matters for Lululemon, and that's helping cause the share price to fall by over 40% so far this year. That's pretty much in line with the declines that we've seen over the course of 2025. Analysts are skeptical that there might be a turnaround anytime soon, and some analysts I read from said that even at these levels, they don't see a buying opportunity on today's pullback, Matt.
Yeah, okay, certainly interesting too. Bloomberg's Stephanie Hughes. Steph, appreciate that today. Thanks so much.
Thank you.
And joining us now for some movers south of the border is Bloomberg's equities reporter, Avalon Purnell. Avalon, we were just touching on it too, the sharp tech sell-off over the course of the day today that included Meta shares late this afternoon. Tell us a little bit more behind that move.
Yes, Meta did fall about 5.5% into the close to end its worst one-day drop since April. And that's after the Financial Times reports that the tech company is considering raising tens of billions of dollars in a stock offering to boost the tech company's AI infrastructure. This is obviously still in the early stages, and Meta has not yet hired banks to issue the stock, so it's not guaranteed that they will actually pursue this plan. However, it is really interesting to see how big tech companies like an Alphabet and now like a Meta are pursuing ways creative ways, you could even call it, to raise cash to manage the ballooning cost of AI. Just earlier this week, we saw Alphabet announce a similar plan. They're raising $80 billion to fund its AI spending.
And a rare bright spot, too, in the markets today. We didn't see many of them, but Chipotle, JP Morgan, getting a little more bullish on the company. Where is the upside? What do they see in that?
Yes. Chipotle was up a little bit more than 4% today, and that is after JP Morgan upgraded the stock to overweight from neutral, citing a rare valuation opportunity. This analyst writing that while consumer confidence may be waning, the current valuation for Chipotle allows investors to potentially be well compensated for crossing this wall of worry. Also, definitely going to be welcome news for those who have been invested in Chipotle for a while, since the company has really struggled to win back those diners as people complain about those portion sizes and also the cost of those bowls and burritos. So definitely a little bit of upside and a little bit of green that we saw this Friday. Yeah,
just a sliver of it, it feels like, to end the trading week this week. Bloomberg's Avalon Purnell. Thanks so much for this, Avalon. Well, job growth unexpectedly surged in the U.S. as well in May, with the labor market adding 172,000 jobs. The unemployment rate also remained at 4.3%. Our next guest sees this report as an indication that the Fed can and will remove its easing bias into June. Let's bring in Michael Gapin, Managing Director and Chief U.S. Economist at Morgan Stanley. Michael, so certainly interesting, but, strong jobs reports on both sides of the border, but in particular for you in the U.S., the third consecutive quarter in which the U.S. has created more than 100,000 jobs. What has ignited this turnaround from where the economy was, just 6 months ago?
I think there are a couple factors that you can look at. One is it's been a year since we really, went forcefully in tariffs. Maybe the tariff shock is passing. Firms have managed the expenditure side of the balance sheet, and maybe it's time to be a little more encouraging in terms of hiring. The other, as everyone knows, is the economy in the U.S. is quite resilient, driven by AI-related CapEx spending. Consumer spending has generally held up, although obviously that depends on what income group you're sitting in. So there's been a slight broadening out in the recovery, and the economy's been resilient to both geopolitical shocks and trade shocks. And so I think labor demand has picked up. We were looking for labor demand to improve this year. It's just it happens to be improving more than we thought. So directionally, it's where we thought things would be going, but certainly there's been a stronger lift than we thought.
Donald Trump's economic advisor, Kevin Hassett, I watched him on Bloomberg earlier today. He was, listen, not shocked, but he was hoping and, was talking about just the upper end of how much it did increase. He called today's report a supply-side driven job market boom. Do you agree with that assessment?
I mean, not necessarily. I think if anything, the AI build out right now is still a demand side story. So you could argue it's maybe the opposite. In the build out phase, there might be greater demand for things like construction workers. That category was up fairly solidly today. You could also argue that, at least until yesterday, given the moves in equity markets so far, that the AI story was boosting wealth effects, which may mean spending from upper income households stays resilient. That drives some labor demand. So I think there's a number of factors that may be behind it. I wouldn't say a supply side productivity story is part of that narrative right now.
Now, healthcare has done, a lot of the heavy lifting on the job market lately. But is there broader strength across other sectors in this latest report today?
Today, yes, I'd point to two other sources. One was surprisingly the public sector, not the federal level, but at the state and local level, non-education hiring was up. Now, we need to see the details. That may also be a healthcare story, which may be a bit of surprise considering we're cutting healthcare insurance support in the One Big Beautiful Bill Act. But local government hiring was stronger than expected, and goods sector hiring was stronger. So in addition to the construction numbers I mentioned, manufacturing was up a bit. Now that's less of a surprise because a lot of the ISM, both the regional and the national manufacturing statistics had been pointing to stronger output in production. The employment subcomponents weren't quite as strong, but in the event, hiring on the good side of the economy was stronger. So we kind of hit on all three cylinders today: public sector, services, and goods.
And I'm curious, can I follow up on manufacturing there too, and how important that is going to be, and how again, at least for now, but also moving forward in that sector for the U.S. economy?
Well, in terms of driving broad-based job gains, it's not as important, of course, than it used to be decades ago. But it can play an important complementary role, right? In a view where certainly hiring at the federal level is suppressed and hiring from services tends to be narrowly driven, having kind of a second or a third gear would be helpful. So I'd say on the margin it could be helpful, but we're a services, technology-driven economy, and that's really where most of the job gains are going to be coming from.
Any weaknesses or any pockets there that did catch your eye in this report?
Well, I would say there's some question marks. One, a lot of this was leisure and hospitality today. Is that, for example, a World Cup story where we're bringing in some workers in advance of the World Cup? We'll let them go in the third quarter. And I would say there wasn't a lot of broad-based strength across all of services sectors. It was driven narrowly by leisure and hospitality and education and health. So if you wanted to pick through some of the details, you could find that. And also, I doubt hiring at the local government level will be this strong going forward. But that said, this is the third straight month, pretty solid employment gains. It's hard to deny that labor demand in the U.S. has picked up a bit, and I think that's healthy for the ongoing expansion.
It has been significant here, these last few reports. I want to ask you, too, before I let you go, about, in particular, inflation. It's on the rise, but in regards to the Fed, too. They're going to meet in a couple of weeks, too, Kevin Warsh's first meeting, and whether they're going to ease, right, at least for right now, not an increase necessarily in the key interest rate here in the near future, but by the end of the year, it certainly feels like the trend is moving that way, given the numbers that we are seeing.
It is in the what I'll call the balance of risks argument. I think, as everyone remembers, a year ago, the Fed said, well, downside risk to the labor market is outweighing upside risk to inflation. We need a policy rate that better balances that risk. This data says things are moving in the other direction. Perhaps the labor market is more healthy than we thought, and it's really about upside risk to inflation. So yes, I think that means that a balance of risk discussion will mean the Fed removes its easing bias in June, and should the data keep suggesting this tension about upside risk to inflation, stable labor market, then yes, that would open the door for potential rate hikes. The market's pricing in at this moment a full rate hike later this year.
Okay, certainly going to be interesting. Michael Gapin, Managing Director, Chief U.S. Economist at Morgan Stanley. Thanks, Michael, for this. Have a great weekend.
Thank you. You too.
Well, coming up, we're going to get some advice on navigating the sell-off we are seeing in the markets today with Bruce Campbell of Stone Castle Investment Management. That's coming up after the break. Stay with us. Well, stocks broke their April and May winning streak to close lower this week, but fueled by strong earnings, massive AI spending, and blockbuster jobs data. Is this rally ready to broaden out? We have Bruce Campbell, President and Portfolio Manager at Stone Castle Investment Management, to talk more. Bruce, thanks for being here.
Yeah, thanks for having me on.
When we get into it, Bruce, clearly, maybe with the exception of today, and we saw that a lot of red right across the board over the course of the day today. But your indicators are still positive. Tell us why you're so optimistic and where you do see some opportunities here that are coming.
We look at a number of different top-down indicators at Stone Castle, and all of those are positive here. We've actually seen, we have an early warning indicator, and that early warning indicator just recently reset. It was negative back in January, kind of anticipated what was going to happen with the March-April timeframe, and is now reset and is back positive. Typically, when we see that happen, we don't see any market weakness for, probably anywhere from 6 to 24 months down the road, depending on the time frame. And I mean, it can always be different, but it just really surprises me that, this would be the start of anything bigger. Significant downside today, though.
Yeah, and talk about that downside today. Is this just the market's pulling back just a little bit? We've seen record highs at different points and a lot of this rally, but this is just a little bit of a blip, do you feel?
Well, I think things probably got really overextended, right? I mean, we've had, what was it, 9 weeks up in a row on the S&P. It's a trend that hasn't, been intact like that for some time. And so when that happens, people tend to get complacent to the wrong direction. And then once the alarm bell rings, it's a really narrow door to go through. And we saw that today, where it seems like a lot of investors were trying to get through that door and they were just selling at all costs.
There's been the debate about, in particular, if Canada is in a recession or not, and the technical recession definition that we did hear from StatsCan. But the job numbers that are out today, very strong too, both here in Canada, south of the border as well. The U.S. manufacturing, we just talked about with the last guest as well, that is also, moving back into expansion. How important are those signals for us and for the broader economy moving forward?
I think if you look at, economically, and especially in relation to that ISM manufacturing data, we've really been in a manufacturing recession going back to really 2022. We only started to see those ISM numbers going positive in the last 5 months, with the exception of that 1 month in January of 2025. They've really been on that downward trend. And that has a big impact on the economy, both, in North America, but also worldwide. And so it doesn't surprise me that, the economy hasn't been strong, but now it's starting to strengthen. And we see that with the earnings as well. So if you look at, what we've seen this quarter, like from the Q1 numbers, they were quite strong. The forecast for Q2 is strong again. And we started to see that earnings growth start to move down in capitalization about, well, not quite a year ago, about 9 months ago now, where we started to see the mid cap and small cap companies in North America start to see earnings. So we really think that we'll continue to see a broadening out. There's always going to be pockets of excess or over optimism, and that could potentially be technology in certain areas here right now. And of course, the market, you never know what's going to happen in the short term. But we, with both the indicators and the economics, we're positive here in the markets.
And again, not concerned necessarily. We have the Kuzma news today, the fact that we're not necessarily going to have a deal. It sounds like we're going to go right past that July 1st deadline. Oil prices, the uncertainty that comes with the conflict in the Middle East, that there still is nothing. That's not, again, at least hampering your outlook too much for now with that uncertainty?
Well, I mean, you compare that ISM data where it's starting to improve. When you look at that compared to, say, consumer sentiment is so low right now. Mm-hmm. And that still doesn't even really probably have the true impact of the oil price, because, as oil has gone up, it went up so quickly that, yeah, everyone felt it at the pump right away, but it doesn't have probably that long-term effect yet. So the longer it stays up, the more damaging that is to the consumer. And that's the one thing that could really be challenging here for the economy, because we know that especially in North America, the consumer is such a big part of the economy that could be, really where we start to see that slowdown if oil prices stay up, inflation continues to be elevated, and the consumer then really doesn't have the ability to spend anymore.
And now I'm curious too, with the economic improvement, with the earnings improvements, and again, staying optimistic, at least for your view, where do you see, can that continue to broaden out, with, again, hedging the fact that we understand, at least with what's happening in the Middle East and some of that, a little bit of uncertainty, but are you watching and expecting that broadening out to continue over the course of the rest of this year?
Yeah, we are. When we look at the forecasts for earnings, just as an example, for the Mag 7 versus the other 493 in the S&P 500, the Mag 7 has been growing the last few years at, call it 30% per year. And now the forecast is for that to drop into the mid-teens for the last part of this year, whereas the other 493 was in kind of the single digit area and is now expected to roll into that low kind of mid-20s range. And so that really gives you a sense that there's broadening out with the earnings. And we know that ultimately stock prices follow what happens with earnings and those earnings trends.
Bruce Campbell, President and Portfolio Manager of Stonecastle Investment Management. Appreciate your time today, Bruce. Thanks so much for this.
Yeah, thanks. Have a great weekend.
Well, up next, we're going to have a look at some of the biggest movers on Bay and Wall Street today and tell you some of the stocks that investors have flocked to today. Stay tuned for that. You're watching The Close on BNN Bloomberg. I'm Matt Scooby. Here is a look at how North American markets finished the day today. We've been talking about it over the course of the day. A lot of red. In Toronto, much of the selling pressure concentrated in three sectors. Those were energy, information technology, and materials. You can also see, again, some of the names in the materials sector that we're seeing the most selling pressure. Euro Copper, Hudbay, First Majestic Silver. Look at some of those numbers, too, down significantly as well. As the infotech space, these were the big losers too as well. Celestica, BlackBerry, the big stocks on the downside. Celestica all down over 12% on the day today. So again, taking some very large hits. And it wasn't just in Canada, but south of the border, those technology stocks also taking some very big hits. There were a couple of stocks that held up quite well in Toronto, a lot of the consumer staples in particular. So Metro up over 4% today. Loblaw also had a decent day, so did Dollarama. But again, that was very little green that we did see over the course of the day today. How about Bitcoin, too? This one has been interesting as well over the course of the last week or so. It is down significantly. We talked about it. It rallied a little bit late in the day. It's back up over 60,000, but it was as low as 57,500 here earlier today. Strategy sold off a small amount of Bitcoin earlier this week, and then we watched that drop as a result too. So Bitcoin at its lowest level since October of 2024. And keep in mind, it was last October in 2025 when it was more than double this price, 126,000. So a little bit of uncertainty, not necessarily Strategy 2 saying, at least for now, not necessarily weakness in Bitcoin in particular, but they're moving some of that and some of what they sold over into AI. And so it's going to be interesting to see what happens here. Bitcoin cryptocurrency, though, has taken a pretty big hit over the course of the day today. Some of the big tech stocks, too. We mentioned them south of the border, but all the big names. Broadcom, NVIDIA, Micron over 13% down today. NVIDIA also taking a very large hit. Concern growing over the sustainability of that AI-fueled rally that has been pushing the chip stocks to records. We've been talking about that, too. Micron is a $1 trillion behemoth, too. So we've watched that, too. Some of the rally and some of the records that we did see this week have certainly been clawed back. It'll be interesting to see how we start next week. Well, up next, we have an interview with the new CEO of B2 Gold, Mike Cinnamon. We're going to be back with that in a moment. Canada added more jobs than expected last month. Data from Statistics Canada shows the labor force added nearly 88,000 jobs in May, well above the 10,000 that economists were expecting. The agency says the gains were fueled by full-time jobs, with construction leading the overall results. Culture, recreation, transport, and warehousing also contributing to the gains. Meanwhile, the unemployment rate fell to 6.6%, the lowest level since January. Bloomberg is reporting that Canada, the U.S., and Mexico will not meet the CUSMA renewal deadline of July 1st. Part of the agreement does include extending the deal for 16 years. If the countries don't agree to renew it, CUSMA remains in place until at least 2036 and will enter rolling annual reviews. According to the report, by declining the formal review, the Trump administration will trigger negotiations and an indefinite period of uncertainty about the agreement. Shares of First Quantum Minerals came under pressure today. Panama is creating a task force to study the miner's shuttered copper mine. The interagency team will evaluate the future of the mine and will analyze a range of issues, including legal, economical, and environmental challenges before making recommendations. The task force is the latest move toward a decision on whether the mine can be reopened. Well, gold prices are lower today in a struggle to match last year's performance due to rising interest rate expectations and oil prices. So how are miners hedging against the yellow metals volatility and the soaring cost of fuel for the rest of 2026? We're joined now by the newly appointed CEO of B2 Gold, Mike Cinnamon. Mike, congrats on the new role. Thanks for being here.
Thanks for having me, Matt.
Take us through B2 Gold's strategy going forward. You know, under your leadership, and at least for right now, and where we're seeing gold prices, at least at this point, you know, what's your plan for the foreseeable future?
Yeah, I think, I'd put our plan into like a short and a long-term plan. I'd characterize it like that. And I think we're going to focus on four real main areas. Like, we're going to execute well, we're going to keep showing capital discipline, we're going to grow responsibly, and we're going to maintain and build our culture. I think, we've just recently had a transition where our previous CEO, Clive Johnson, is retired. So want to make sure that we retain our culture as we move forward. On the execution side, B2 is very well placed right now to do all. I'm very optimistic about B2's potential to grow and be even more successful. On the execution side, there's two primary things we've got to do in the short term. The first one is to complete the crusher remediation that we have planned for our Goose mine, our newly minted Goose mine. We'll do that in the third quarter of this year and then the first half of next year. And when we've completed that remediation plan for the crushing circuit, we're going to be able to produce approximately 300,000 ounces a year from the Goose mine on an annual basis. So we're excited to get ourselves there. And the other key thing that we want to execute on is bringing the second piece of our production in Mali online. We're waiting for the final grant of Fekola Regional License, and when we have that, we think we're going to be able to add approximately 180,000 ounces of production at Fekola. So those are two key things, I think, that will really let us lock in some of our longer-term production profile. Then on the capital discipline side, we've had some significant investment years here over the last few years, especially with the building of Goose, and we're starting to reap the rewards of that. I think you'll see really strong free cash flow starting. We already had a strong Q1, but certainly in the second half of 26, you see us generating a lot of free cash flow, and that just increases over 27 and 28 if we keep executing the way we're supposed to. So, we've got to make sure that we manage that well. We're also looking at managing some of our strategic investments, recycling some of our investments in juniors. And you recently saw, I think we sold our Finland asset for approximately $350 million to Agnico. So we're very happy with that sale. And I think you'll see us continue to do that, focus on some of the other investments we have. And all of these things, they strengthen our balance sheet. They strengthen our share price. That's key, I think. We want to make sure that we actually reflect the value that we see in the business in our share price, and executing well on these things will help us do that. And then as we generate these funds, we have to decide and use them responsibly. So certainly over the last 6 to 9 months, we've focused on returning cash to shareholders through dividends and returning it through our normal cash issuer bid. So you'll keep seeing us do that. And the reason we're buying back our shares is because really we drink our own Kool-Aid. We believe our shares are undervalued, and we think the good use of our capital is to buy some back in the market while we see them being undervalued like they are, right? And then the cash flows that we're generating, it also positions us to grow our business, right? But that growth, it has to be responsible growth. My goal as we move forward here is we've been at the 1 million ounce level before. We're slightly below that right now, but we're climbing our way back up to 1 million. And my goal is for the long term is to be able to see a production profile for this company of 1 million plus ounces per year. And we can do that in a number of ways. One is to just maximize the efficient operation of our existing mines. And one is to look at the gold price. We're in a higher gold price environment than we have been. It's been sustained for a while. And I think it's incumbent on us to look at what that means, certainly for our open pit operations. We've got, especially our Masbate mine in the Philippines and Otjikoto mine in Namibia. I want to see what that gold price can do in terms of expanding maybe our open pit operations there and adding some extra production or a longer production profile for those mines. And then we also want to look at our brownfield opportunities that we already have within our company. One, we have the Gramalote project in Colombia. We own that. We're waiting for license permit modifications to come through. So we'll probably get to a decision point on Gramalote sometime mid-27. So we know that may be something that we can look at to add to our production profile. And then we also want to focus on brownfield exploration. We already have near our Goose mine, we have the Goose mine running right now, but we think that's a district up there. We got 80 kilometers of banded iron formation, a belt there that we really think there's potential to grow. So we have, for example, deposits like the George deposit where we already have a resource, and we're allocating significant exploration dollars to that this year to see if we can add more to the pipeline. And as we look down the future for Back River and the Goose Mine, we can see maybe a new mining development there. So these are things, all these things that we can add to our pipeline.
Yep.
And then, you know, long-term exploration as well. The exploration is the lifeblood of a mining company. So we're making sure that we do maintain our focus on exploration around the world, but we're definitely focused on sort of key high potential jurisdictions. So you see us right now looking at places like Guyana and Suriname. We think they hold the potential to add to our production profile. Like if we look a bit further down the line to help us keep that 1 million ounce goal. And the other part to growth I should mention is M&A. That was the lifeblood, I think, or that's how Bema and B2, Bema before B2 and then B2 as we are currently, these companies grew. But it's not the right time for us for M&A. We have, like I mentioned before, we have to execute well on our current strategy, and we have to do the things that help us grow our share price and give us that financial firepower, both in terms of the strength of our share price and our capability to generate cash flow. We have to execute those first before we can really come back and look at M&A.
Yeah, Mike, let me ask you about, how are you hedging against rising fuel costs too? Are you expecting higher fuel prices, along with the broader inflation, and potentially you touched on the lower gold prices too. Is that going to pressure margins for the rest of the year?
Yeah, well, you can't do much about controlling the gold price, right? But mining companies can control costs. So we've had an active fuel hedging strategy for many years. And what we've typically done is we've hedged up to 50% of our first year's needs for the next 12 months and hedged 25% of the next 12-month period after that. And so where we find ourselves right now, we find ourselves relatively well positioned even in this higher fuel price environment. And that's for a number of reasons. I would say one, we have this hedging program. So we've got, say for the balance of 26, we've got close to 40% of our fuel needs hedged at or below budgeted costs, which are significantly lower than current fuel prices. But we're also hedged just the way our operations are positioned. So we actually have solar capability in 3 of our mines, Otjikoto, Fekola, and Masbate. And that helps you lower the fuel needs for operating your mill. So we're very well positioned there. And then for the Goose Mine, because of where it is in the Arctic, we've already got all the fuel we need on site. We bought it last year and we've shipped it into site. So it's already there. We bought it at lower prices. So we'll see that benefit of those lower prices, certainly for the operation of Goose in the next year. So we feel pretty well positioned on the fuel side.
Okay, those are all important updates for sure. Mike Cinnamon, CEO of B2Gold. Appreciate your time today, Mike. Thanks so much for joining us.
It's really great to talk to you, Matt. Thanks for the time.
Well, up next, we're going to hear from the CEO of Descartes Systems on what's behind their Q1 performance and how ongoing disruptions in global shipping could impact their outlook. That's just ahead. Descartes Systems reported a strong first quarter driven by higher demand for its supply chain, customs, and trade intelligence software, but the company is still navigating weaker freight volumes and ongoing disruption across global trade routes. For more, we were joined by Edward Ryan, CEO of Descartes Systems.
Markets were down about 4%. We were up about 9.5% organically, so we're real happy about that. We had a lot of products that were, really performing well, and customers were buying more stuff from us. We've done a pretty good job of taking business away from some of our competitors, and it all added up to a big quarter. AI has been starting to kick in for us as a revenue stream now, and so you probably picked up a couple points from that as well. So it was a good quarter for us, especially considering the freight markets were down a little bit.
With the organic growth at 9%, do you feel that's sustainable, or is it going to come back down a little bit?
Well, we'll have to see what happens to our customer base. I think we're going to continue to do well. We're going to continue to be able to sell our software solutions. There's a lot of complexity in the world with some of the wars going on and trade conflicts. That usually helps us quite a bit. If the freight markets turn up, I think we could do even better. We like where we are right now. I think we can continue this kind of growth for a little while, at least.
And you mentioned about taking away from competitors. Was that with lower prices, or was that, or did you maintain prices and just the quality?
No, quality service. A couple of the businesses we operate, we just do a better job than anyone else in the market. And I think over time people have decided to switch to us, and switch, in the Type 86 filings, which is de minimis filings that you might have seen the U.S. Eliminated. They switched the filing type. We ended up picking up a bunch of business there from competitors that didn't really run a network and couldn't process the transactions as fast as they needed to kind of get the business. We picked up a bunch from that. Our MacroPoint business is really doing well and picking up a lot of business with freight brokers and stealing it away from some of our competitors over time. So, probably 4 or 5 businesses of ours are really just doing a better job than our competitors, and as a result, picking up, market share.
And now there were some challenges. You had your overall gross margin compression decline, operating expenses grew. What was behind those?
As our business grows and as we buy more companies, you're going to see our operating expenses grow. They will naturally with that. I don't care really. We're growing our EBITDA margin 15% a year, and in fact, this past year we just did 20%. So we tell people we'll do 10 to 15% or better, and oftentimes we do better. This last year we did 20%. So you're going to see our costs go up when that happens, right? Because we have a lot more revenue coming in, and we're turning it into more profits. That's exactly what you want to do. But as the business grows, we're going to have our costs grow as well. We think we're pretty frugal and manage our costs pretty well, and that's why you see us putting up 46% EBITDA margin, which is a very healthy number. But as we grow, we're going to have to grow our expenses. Of course, we need to keep building more product and buy more companies, and that has additional costs. And so that's just the way it is.
And with that, you've got a pretty good war chest going on right now. What acquisitions do you see coming down the pipe or possibilities? And is it better in the circumstances we're in right now, or is it more challenging when you're trying to do some M&A?
It's actually it's gotten a lot better. You see what happened in the public markets, the software stocks. I don't know that we feel that was fair, but it is what it is, and that's now hitting the private markets. And as it does, you're seeing the game that was going on for the last 10 or 15 years with private equity firms getting largely free money from the government and banks. And, we always made our profits and we used that to buy companies. And, that's becoming, a great way to have done it because, as we make more money and we keep making more money every day, we're in line for these acquisitions and we have the money to do it. And when, some of the sources of funding that private equity firms had start to dry up, they're not competing against us anymore. And we're, competing for these deals either to buy stuff from private equity or from sole proprietors. And, we have the money to do it because we're making a ton of money every quarter operating our business. As the market's settled out here a little bit with private companies, we find ourselves in a situation where we're one of the few guys at the table and there's a lot of stuff for sale. So that's been great for us. And I suspect it will for some time to come. Similar to what happened in, 08, 09, 10, 11, as coming out of the recession, we were one of the few guys that were still making money and able to buy companies and most of the other people were not at the table.
And you mentioned in the call, but you don't see yourself as a software company.
We're a network. I mean, we process transactions for a living. We have a very unique data set as a result. That data set is very well positioned to take advantage of AI. You can already see that in some of our numbers as we're rolling out new AI functionality very quickly. The beauty of it is we're able to build it fast because of the way the tools work. And we're able to leverage the data that we have on our global logistics network into tools that can really help our customers operate more efficiently. Of course, that's all written in software, but it's, I don't sell the software very often as just like a per seat, kind of software package. It's people use our network to communicate with their trading partners and execute logistics moves and manage their supply chain. And that makes us a little different from a lot of the software companies that have been getting hit hard in this, last 6-8 months. And at the same time, we're in a technology fund. If someone wants to sell out of that technology fund, they're going to sell our stock as well at the same time. As I think that's going to end at some point and people look at us, they're going to go, hey, these guys are different than the rest of the software companies out there, and they're better positioned to take advantage of AI. And I think that's going to be an attractive time for us.
That was Edward Ryan, CEO of Descartes Systems. Well, still to come, the provincial push in Washington is growing doubts that a CUSMA deal can be reached by the July 1st deadline. Stay with us. Bloomberg is reporting that Canada, the U.S., and Mexico will not meet the CUSMA renewal deadline of July 1st. That news comes as federal negotiators continue to meet with trade representatives. But federal officials aren't the only negotiators making their way to Washington. Several provinces have their own trade offices in the U.S. Capitol. CTV's Abigail Beeman now on what, if any, impact the provinces are having.
When half a dozen Manitobans met with U.S. officials to talk trade this week, it was a first in history.
Manitoba produces about 8.5 million pigs every year. 3 million of those are exported live into the United States. Those exports are at risk if we don't have the protection of the trade agreement.
They signaled that even though the president signed the agreement 6 years ago, he's not attached to it. So there are some irritants that need to be worked out.
Manitoba is the newest province with an office at the Canadian Embassy. Ontario and Alberta have had theirs for 1 and 2+ decades. But in this trade war, the 4 provinces in D.C. meet bi-weekly around this table. Ontario's representative says it's been effective.
We hope that helps our federal government on things like doing trade agreements, because so many of the things that are in the American interest really rely with our the domain of the provinces.
One of the things I do is like to show them oil sands.
The reps spend a lot of time scene setting to Americans. Alberta's brings this sample to meetings. Nathan Cooper says the issue of Alberta separatism hasn't played a significant role in talks.
On occasion, I'll hear from members of Congress, more so out of an interest of like what's actually happening there. But it very quickly moves on to the key issues that we all face together, which is largely energy and agriculture.
President Trump's back on his high horse, saying we're going to be a 51st state. I can tell President Trump that will never, ever happen.
Asked if some of Doug Ford's comments make his job harder on Capitol Hill, David Patterson says he's met with 150 Republican lawmakers and has not had a bad meeting yet. He's optimistic about a CUSMA deal, but not by July 1st.
If the United States is willing to do it, I hope they are, because I think it's in their self-interest. And so let's get it done by Labor Day.
Ontario's premier visits Washington next week. Alberta is focused on hosting U.S. lawmakers at the Calgary Stampede and beyond. Quebec didn't get back to us. Abigail Beeman, CTV News, Washington.
Let's have a look once more at how North American markets finished the day today. In case you missed it earlier, haven't been paying attention, a lot of red on this Friday. In Toronto, a lot of the selling pressure concentrated on 3 sectors in particular: energy, infotech, and materials too. We talked about it too in the energy sector for the TSX, down to over 3% over the course of the day today. Tech down, information tech that is, over 5%, and materials, some significant hits that were taken there today, down over 8%. We want to have a look at some of the metals too, which is why materials was overall lower today. Gold futures, again, gold, the price of gold continues to dip, down $150 today, at least for now, down to the 43, just over the 4,300 mark. Silver also down, copper down slightly, not as much of a significant hit that we did see with silver, but also, at least when we talk about those metals, one of the reasons why the TSX was down so much today. Let's have a look at some of the names too in the materials sector that under the most selling pressure too. How about Aero Copper, which was down over 16%. Again, look at some of those red numbers. Hudbay Minerals also down today. First Majestic Silver Corp also again a lot of red as we get a lot of pressure as we've seen some of the increases certainly clawed back from some of these energy prices as well, weighing on the energy sector today. WTI oil down over the course of the day today. Gasoline lagging behind too, so there's a slight green arrow, but not by much. Natural gas also down to over 3%, almost 3.5% for your Friday intraday trading. Some of the names to the downside in the infotech space too, we talked about them. Celestica down over 12%, had a really tough day. BlackBerry down over 9% too. For at least for today, we're going to watch some of those rebound possibly, but this is, again, this is right across the board. Some of the stocks did hold up. There were a few of them. Consumer favorites, Metro, Loblaw, Dollarama, all in the green, at least for now, but some of the major banks were trading lower too, and some of the rest of the commodities were also in trouble. Bitcoin also had another rough day over the course of the day today. Down, it did rally a little bit near the end of the day, so down 3%, but we're hovering right around that $61,000 mark. Half, just 50%, right, just cutting half of that all-time high that we did see only a few months ago. So that's been the day, not the best. That does it for today's program. Thanks for joining us on The Close. We'll see you on Monday.